Let's forecast this pro forma model for some unnamed company that sells widgets. And widgets are probably some measure of the company's activity level, how many units we sold, or how many square feet of store space, or how many barrels of oil we produced. But we're not going to use that method. We're just going to forecast sales based on an annual growth in this video. So for now, I'm going to hide this. We'll come back to it later. What you see is we're starting with the income statement. We've got the historical income statement that we pulled from the 10K. Also pulled a little bit of share data and some retainer or some dividends. That's our history. Here in a moment we'll forecast some ratios and use them to predict some drivers. And from those we'll come back up here and forecast our line items. Now notice on the left I've color coded these so that while we're in the yellow, that's income statement activity. When we get down to the blue, we'll do the same approach on balance sheet with history, ratios, drivers, and forecast. And then when we get to the cash flow, we don't really have ratios or drivers because we can calculate a cash flow statement, generate a cash flow statement from just the other two. So we can generate it for history or generate it for the forecast. And then the same thing for our free cash flow that we're going to use in the discounted cash flow calculation. We'll calculate it for history and calculate a forecast. And then it will be time to do our DCF. So we'll calculate a weighted average cost of capital. And the only assumptions I've put in here, besides the historical income statement and balance sheet, are something called a long-term free cash flow, and something called an exit multiple, and something called our cost of equity. So we'll get back to those here in a moment. And from that, we're going to get down to share price. Then we're also going to calculate some ratios that give us some idea about the health of the business. We'll come back to that later. For now, let's get to forecasting. First thing we want to do is say how quickly are our sales growing. So this year's sales over the previous year's sales minus 1 says they grew at 4% that year. And our cost of goods sold were about 60% of sales. Now, I could take that negative sign off, but we're just going to leave our outflows as negative, and we're going to leave our ratios that represent negative outflows as negative. And then our overhead, SG&A over sales, looks like about 6%. Now we're going to do a balance sheet ratio, so we're going to have to take the average of something. So we're going to take the depreciation up here, divide that by the average, and I want the average balance sheet item from last year, which represents the beginning of this year, and this year, which represents the end of this year. The average of the two will represent what the value was across the year. Now, unfortunately, I don't have enough data to go back and see what net fixed assets were the previous year, but I'm going to write the formula that way, and then when I copy it over to 2020, I'll have 2 years to average. Excel, when it averages a blank cell with a number, just gives you the number back. So I'll get a ratio there. It won't be quite as accurate because I'm only using a year-end number. But I'd rather have a slightly inaccurate number than no number at all in this case. Now interest we're going to do about the same. So if we paid some interest expense, it stands to reason that that amount divided by the debt, in our case the average debt, that caused us to have to pay that interest expense, should give us our cost of borrowing. So about a 5% cost of debt for us. And then we want to see what kind of interest rate we were making in our interest income divided by our average cash and marketable securities. That was about 1%. Now all those things on the income statement that I didn't know where else to put, I just put in this other non-operating expense. It's a very small percentage of sales. My effective tax rate, of course, is just the taxes divided by the taxable income. Show that as an outflow as well. And then the dividends per basic share, just the dividends, divided by the basic share count. We want to use basic share count here because that's the share count that we pay dividends on. If Some convertible securities got converted into shares, or options exercised is usually how that works. And it'd be a slightly higher count. So the 61.8 is included in the 63.1. We'll use it below when we calculate equity value. The basic share count growth is just this year over last year, -1. And the amount of diluted shares relative to the amount of basic shares says we just had slightly more, about 2% of the total were diluted. So if we highlight all those and do a Control R, fortunately in a classroom example we get some pretty consistent ratios here. Everything was the same from year to year, except when I didn't have a number for my first average on the net fixed assets. So if I were going to forecast these, this one would be relatively easy. I could even take this formula that says look at the cell to the left, and if I copy it and paste it just as a formula, then everything here is looking at the cell to the left, and that's a quick, easy way to pull everything over to the right and use drivers that represent the ratios we saw in history. Now we can use and not mess up the formatting, by the way, if we paste them as formulas. So if we come up here and say, well, sales, if it's growing at 4%, must be 1 plus the growth rate. And if cost of goods sold are just sales times this number, then we can add those together to get gross profit and multiply SG&A ratio times sales, alt equals to get that sum. And we have our EBITDA. Now our depreciation we said was going to be 9% of the average net fixed assets down on the balance sheet. So let's go find them. And notice I don't have a number here yet. It'll give me a number. It's not going to work as I copy the cell to the right because eventually I'm going to run out of numbers to average. But eventually we'll get something there populated and we can use it. So the EBIT, now that we've taken the DA off, it's about 170. And I'm keeping an eye on these things to say, am I on trend here or did I leave a negative sign out, for example? And most of these seem to be on trend. All of them seem to be on trend. Our interest expense, we said our cost of borrowing was 5%, so times our average debt. And our interest earned was 1% times our average cash. We can sum those two. Now your model, every model that I hand out is a little bit different, partly because they improve all the time and partly because I want you to be thinking about these, not just memorizing cells. So our non-operating expense, I think we said was 0.2% times sales. And that gets us to our, now here I'm going to have to be careful. We need to add the EBIT along with the net interest expense and the non-operating expense. Don't fall into the trap of double counting these interest numbers because they're already in the net interest expense. And it's a good sign that I'm still kind of on trend there, it looks like. And so if I multiply that by my tax rate, negative tax rate really, then I find out my taxes and I can find out what my net income was. The dividends, I think we said we were paying about $1 a share. So times, I'm going to put a share count there. I don't have it there yet, but that's okay. I'll populate it here in a moment. And then when I add those together, that's the retained earnings that will flow down to the balance sheet. And it should scare you. I'm not on trend here. That's way too big relative to that. But it's because we haven't populated the dividends yet. And that's because we haven't populated the share count yet. So the share count, I think we said, was growing at a rate of 1%, which brings this line into trend and this line onto trend, and that line's on trend. And I think we said that the basic shares times 102% gives us our diluted shares. Now hang on, we're going to copy these forward, but don't get scared. Control R. We're doing a lot of divide by zeros here when we run out of things Remember I told you it would eventually be averaging some blank cells here, and the math doesn't like that. But once we get down there and populate those cells, they'll no longer be blank, and these should work. We won't worry about share price yet. We'll come back to it. Right now, let's forecast the balance sheet. And since a lot of these ratios down here are going to be the change in a balance sheet item, I can't really start my ratios until right here in this year 2020. Now, there are 3 lines on here that aren't technically ratios. These are user inputs. So let's say we wanted to reflect spending $100 million in capital. We wanted to issue $200 million in debt and issue $300 million in stock. Let's see how these numbers work. I'm going to say $400 million just so the numbers are more clear. And let's say the user entered those. These aren't really things the modeler has to choose, but the user could come in here and change these, probably from the dashboard, in fact. The first ratio I want to do, though, is accounts receivable is days of sales. Well, if I were doing accounts receivable as a percentage of sales, I could just divide it by sales. So that would be a year's worth of sales, right? But if I take the sales, which are up on E15, and divide them by 365, then that numerator now, the denominator gives me 1 day's worth of sales. I take the year's worth of sales, I divide it by the days in a year, and I get the day's worth of sales. And the reason I want to divide accounts receivable by days worth of sales is it tells me on average it takes about 15 days to get my bills, or to get my payments from my customers. And so if I could improve that going forward, it would help my cash position by reducing that account on the balance sheet. Similarly, let's see how much inventory I keep. So if I have inventory of 98.1, and I want to divide that, where sales are probably a good measure of accounts receivable, the stuff in the warehouse probably better measured by the cost that it took to get it there. So we'll divide that by cost of goods sold on E16. And again, we'd like that in days. So if I divide E16 by 365, that's days of cost of goods sold. And since E16 is an outflow, I'm going to stick a negative sign in there just to get our signs right here. And that says on average, my inventory is sitting in the warehouse for about 100 days. So if I could decrease that going forward, then I could reduce that account on the balance sheet, which would end up in cash that we could maybe create some value with. Other current assets as a percentage of sales is just equals that number divided by E15. Other non-current assets is equal to that number divided by E15. And accounts payable as days of cost of goods sold. Same thing as we did above, like the inventory. If we could say accounts payable, we'll take that number and divide it by not E16, which is cost of goods sold in a year, but that divided by 365, which is cost of goods sold in a day, and then put our negative sign there since that's an outflow. And it says on average, we're taking 50 days to pay our own bills. So if we take 50 days to pay our bills, but our customers have to pay their bills in 15 days, then we're realizing a positive effect on working capital because of that. Let's move on down to other current liabilities as percentage of sales. That divided by E15. And other non-current divided by E15. And these are just extra accounts that we're not going to think so strategically about, so we'll just scale them to sales by taking the percentages. Now, since this is a classroom example, we're just going to assume that each of these are correct, and we'll carry them forward through history for now. We can come back later and change them and see the effect. So if I just take the cell to the left and then I copy, paste special formulas, then it'll pull everything over with the right formats. Now let's use these drivers to do our forecast. You can't forecast cash that way. We're going to forecast cash from the ending cash on the cash flow statement. So that's going to be equal, down to our cash flow statement, which we'll do here in a second, and grab the ending cash from that. Right now it's 0, but when we do the cash flow statement it won't be. our accounts receivable, if they were in days of sales, then we'll take the days of sales, divide it by 365 to get years of sales, and then multiply it by F15 for sales. And then the inventory, same thing. We'll take the days of cost of goods sold, divide by 365 times the negative cost of goods sold, which is on F16. I'll make sure I used F up here. Yeah. And then the other current assets, we said is a percentage of F15. And the total current assets, we can add those up. Let's make sure we don't get cash because we want to exclude cash in this total. The model's telling us, the template is telling us. And then our fixed assets at cost. What are these? These are all the cumulative capital expenditures we've ever made, less any write-downs or sales. So if I take the cumulative from last year and add in that $100 million in capital we want to spend this year, we see it going up. Accumulated depreciation also is a cumulative number since the beginning of our accounting, so we'll add in. It's a negative account, and depreciation up here is an outflow on row 20, and so we'll add it back, and that number should get bigger over time. Unless we sell something and then we need to take out its associated depreciation. Add those two and we get the book value of our assets. So this is how much those assets contribute to our total assets. It's that cumulative amount of investment minus the cumulative amount of depreciation we've ever taken to get to the book value, or the net PP&E. And then the last one on the asset side is our other non-current assets times F15. If we add up the things that actually contribute to our assets, they are the cash, the total current assets, the net PP&E, and the other non-current assets. So think about this. I'm making you remember that formula so you'll get more comfortable learning your way around the balance sheet. And then of course we're out of balance now because we don't have any liabilities or equities. So accounts payable, I think that was in days. So our accounts payable, convert that to years, and then multiply it by the negative outflow, which represents cost of goods sold in F16. Each time I do one of these, I want to make sure it's on trend with history. It might be a good indicator that I forgot a negative sign or something. Other current liabilities is just a percent of sales, so we'll multiply that by F15. Add those two, and then however much debt we had before plus however much debt we issued this year gives us our debt, and our other non-current liabilities times F15 gives us our last liability. So if I add the total current liabilities to the debt and non-current liabilities, I'm going to get my total liabilities. And now let's calculate the stock on our balance sheet using what it was before plus any additional stock that we issued. If that were a negative number for repurchase, of course our stock would go down on the balance sheet. And then the accumulated retained earnings, or however much we had accumulated in the prior year, plus whatever was left over from our net income after paying dividends, gave us our retained earnings. So we'll accumulate that on row 69. And then we can add up our total equity. If we add the total liabilities and the total equities, we get the bottom line of the balance sheet. And we'd love to see it match, but remember we have zero cash so far. So now it's time to go get the cash. And a very common question on finance and accounting exams is which of the three statements can be derived from the other two? And we're going to prove that it's the statement of cash flows that can be created from the other two. So we'll begin with net income, which right now is the best representation of how much cash we made, but we know that it includes some non-cash items like this depreciation up here in F20. So since that was negative, let's put a negative F20 and add back that depreciation. The plus over here is not an indication that you need to add cell F20. It's an indication that you need to add back the absolute value of depreciation. So in this case, it required a negative sign. If our income statement didn't show depreciation as an outflow, we wouldn't need that negative sign. Just make sure that you're increasing your net income by the amount of depreciation on the cash flow statement. And let's talk about current assets. It suggests it needs to be a negative if there were an increase. And why would that be? Well, think about a current asset. These things include things like inventory or accounts receivable. And so to the extent that, let's say, our inventory went up, we had to spend cash to get that into the warehouse. So it's a use of cash. And so if inventory actually did increase, we'd want to see that as a negative, and that's why we see the negative sign in parentheses. On the other side of the balance sheet, it's the opposite. If we had bills that we should have paid but we didn't, over here in total current liabilities, then that was actually a source of cash by putting off those bills for a while. So if we add all those together, we get our cash flow from operating activities. And we're ready to go look for cash flow from investing activities. So what kind of investments did we make? Well, we know that we spent that $100 million on some capital. So that was a use of cash. So it's going to be negative. So the $100 million that we put up here that increased our gross PP&E, we need to subtract that back off. And then that should show up as a use of cash. And if we had some other non-current assets that weren't quite as easy to identify as that $100 million, let's go ahead and take them off as well. And really what you're seeing is that any increase on our balance sheet that's not cash needs to be taken back off as a use of cash. So other non-current assets, again, shows up as a negative if it were an increase. And similarly, if it were on the other side of the balance sheet, over here in other non-current liabilities, it will show up as a source of cash if it were an increase. And so add those together, and we get 100.5 from our investing activities. Now that debt that we issued, the whole point of doing that was to raise some cash. So current debt minus previous debt shows that we did in fact raise 200 in cash, and that 400 in stock that we issued, 700 minus the 300, shows that we did in fact raise 400 in stock. And now the dividends that we used to pay our shareholders, so what we took out of the net income and paid the shareholders with, was a use of cash, so it's negative. And so our cash flow from our financing activities was 536.9. Add all those up, we get the total change in cash. Compare that to the cash that we started with at the beginning of the year, which is the same as the end of last year. And we should end this year with 1386.4 in cash. So let's refer to cell F112 up there to plug the cash. Oh, we already did. So it's looking at F112, the bottom of the bottom of the cash flow statement, to get that cash amount. And since we didn't make any formula errors on that run through, the thing balanced. At this point, if it's not balancing, then you probably got a negative sign wrong or referred to a wrong cell. But that gives us an idea of how these three statements work together. Let's copy this forward with a Control R. And we're out of balance in the future years because we have no cash. So let's go ahead and calculate cash for the future years and see if we went into balance. We have now balanced and forecast a three-statement pro forma model. However, there's one tiny detail that we didn't address. You may remember a row on here we said we'd come back to called share price assumed for stock issuances or buyback. Remember on row 46, we had noticed that share counts were growing 1% per year, and we chose to continue that and increase those basic share counts. But remember, we didn't get any cash or stock benefit on the balance sheet. So we need to adjust the balance sheet for this. And then also remember that when we were down here and we issued $400 million in stock, while we adjusted the liability or the equity item on our balance sheet, and then the cash flow caused it to increase cash by that amount and keep our balance sheet in balance, we didn't change the share count for that. So we also need to increase the share count for this. Now, the next minute or two of the video are going to seem a little bit complicated because we're doing both things. I think going forward, it's probably better for you to just have a manual line to increase your stock. But if you don't want to go to that extent, if you know you're not going to be playing with the capitalization of the company, you can always just increase the basic share count growth based on history. But again, we need to either adjust share counts or balance sheet for both. So to do either one, to convert stock that we issue to shares, we need to assume some kind of a share count. And so we don't know what's going to be in the future. We could calculate it based on a PE ratio from our net income, but I'm just going to say $22 a share. For our purposes, that's going to be well within the range of accuracy that we need. So how does the share count change? Well, first let's do this one. How does the balance sheet change if I issue 1% of shares at $22 a share? Well, the stock line on the balance sheet increases not only by what we manually issued, but also by 1% of the previous year's basic share count times the dollars per share. So an extra 13, 14 million. We'll copy that forward. So now we have made that adjustment. And then how do we make this adjustment? How do we increase the share count for this 400 million? So the share count that's already growing by the 1% needs to also be increased by these dollars divided by the dollars per share. And so in the year of our big stock issuance, we went from the low 60s to the low 80s, but after that, we just continue to grow at 1%. So a little bit of an appendix detail there. If we weren't growing in both this format and this one, then we wouldn't have needed this last little bit of the video. We were just taking care of it on our way through the video. So thank you again for watching. I hope you enjoyed seeing the three-statement model get balanced and forecast.